In this video, I'm going to talk about the CCI moving average trading strategy in Forex. Stay tuned. Hey traders, a very warm welcome to you. Okay, so I've been looking at this strategy. I found it online. I'm going to share it with you and share it with you guys. I've adjusted it a little bit because I'm going to be honest, when I first looked at it, I thought this is great. I like this kind of thing. It's very similar to a strategy I've got already. Go and check out some previous videos where I talk about some of the strategies I looked at before. But let's just talk about what we've got on our screen. Let's talk about how I've adjusted it. And then I'm interested to know what you think in the comments below about the tweaks I've made for it. So we've got a pound US dollar chart here on a daily. Now it can be used on probably any of the major currency pairs you've got out there, and I would expect even commodities like gold, crude oil, and some of the major indices, possibly stocks or not. I guess the gaps might affect it a little bit with stocks, but let's just stick to the major currency pairs for now. I have on my chart here two moving averages. They're both exponential. One of them is a 50 period, and that's the red one, and the kind of cyan one here is a 25 period. Back to those in a second. I've got a CCI on the standard 20 period settings, and you know what? I need to make that yellow because I just prefer it to look at. I've got it on standard kind of default settings other than that, whereas above 100 is overbought, below minus 100 is oversold. Okay. Now the changes I've made to the kind of settings that I saw the inventor, if you like, of the strategy talking about were the moving averages. They were a little bit low, I thought, for the purpose of it. I get what you're trying to do here. So let me just tell you what the rules are, and then we'll kind of drill down a little bit. So the rules of this are, as the moving average, the quicker moving average, so in this case it's going to be our 25 period, as it crosses down over our 50 period, oops, disappeared our CCI, then that's the first stage of our shorts, the first kind of filter, if you like, to go short. We don't go short on the cross. We now wait until we get an overbought reading on the CCI, and then we go short. Now it suggests using kind of a bearish candle pattern or something like that. I guess you could use a turn down in the CCI or anything like that as a final kind of trigger. So first filter is the cross. So as long as the faster moving average is below the slower moving average, you're past the first filter stage. Then you need to see an overbought stochastic. I think of stochastic because this is kind of what I use normally for kind of an overbought, oversold. And actually you can use RSI, stochastic, CCI. Very, very similar. Let's stick to the rules that we were given. CCI then has to become overbought, but don't forget you're still below the faster moving average, still below the slow one. And then you're looking for a short, and that's either going to be a kind of a bearish candlestick pattern, like an engulfing candlestick. Go and check out some videos if you're not familiar with those. I've done a few videos on the candlestick patterns, or maybe something with a big kind of wick to the upside, something like that if you want. Or I think you can kind of take it as perhaps you start rolling down below minus 100. So let's look at a couple of examples here. We've got, and on a daily chart, I think you can use it on a 15 hourly, 4 hourly, that kind of thing. Anything below that, you're probably going to get hammered out in noise, although you might be able to dampen that off by adjusting the moving averages a little bit. But anyway, let's have a look at what we've got. So down move here, crossover here. Obviously this was an event, but we'll look at some other stuff as well. Comes down, so we're in trigger 1, filter 1 should I say, criteria is met. We now first overbought condition here, which matches up with here. That's actually a very nice entry, gives us a very nice kind of move on that. That's a good trade. And then you get another one here where we go overbought here. You're probably going short around here. Stop. You know, how do you place your stop on that? I would suggest if you're using a candlestick method, you place it above the prior candlestick. So let's say you went on that one there, you're probably going to be stopped out on that. Do you take it again when it pops up? That's going to be up to you. Obviously, if you did, that's resulting in a very nice trade. And this kind of thing makes sense to me. I like this because it makes sense, because you're in a downtrend, but you're waiting for a pullback against the kind of the flow of money, which is the bigger downtrend, and pushing into an overbought, but within the kind of the whole bigger picture of a downtrend. And I like that kind of thing. That makes sense to me, and I like to think sort of carefully about it. How many times can you take it? I've got a similar strategy where I'll only take it on the first overbought condition. So I have the kind of it doesn't use a moving average, but let's say we have a trend day down here, we have the first pullback, the first overbought condition, which obviously would be down here if we're doing that. I only take the first one, I don't take the subsequent ones. That's not to say I don't think you can. I think you probably can quite comfortably do that. Obviously you can take anything, guys, as long as you're capturing that risk and you're managing kind of the trade. Let's have a look at another currency pair like the US dollar JPY. I've got the drawing pen up. I have. Let me move across a little bit. Where are we? So we've got a cross here, and actually this is why I've used a slightly wider moving average. The initial settings were something like 9 and 19, and they were just too tight. You know, every time we got that pullback against the trend, you'd never get an overbought or an oversold whilst they weren't crossing. Oh yeah, and just I think it's pretty obvious, guys, just to remind you, if the moving average then crosses back the other way, you know it's negated. Obviously you're flipping what you're looking for. You're always looking for the long if the quicker is above the slower, or the short if the quicker is below the slower. So here, you know, we've crossed above it around here on the US dollar JPY. The first oversold condition was here, and you got a kind of bullish reversal candle, a bullish reversal pattern here, and actually that's a beautiful, if you caught on the end of that one. So your filter is here, criteria is okay, looking for long, waiting, there's my oversold condition, wait for it to roll back up, or wait for some kind of candle. That's not a bad little candlestick pattern like that, is it? You take that, you put your stop below that low, you maybe trigger it on the close if you're being conservative. I'd say that's fair enough, or sorry, in this case that would be the close here. There's your stop here, not a lot of risk. You're talking, what are you talking? I'm just eyeballing this, you know, it's 60 ticks or so risk, 60 pips, sorry, and you know, look at that, it's several hundred pips. Obviously that's a good example. Let's have a look at something else, one more before we call it a day, guys. Do we have one here? This is one where you don't get it. You get the crossover to the downside, but you don't get an overbought condition. You almost get it here, but not quite triggered. And then when you do get the overbought condition, this stochastic is pushing back up over. So let's see if we can find just one more little sneaky one. That's not a bad one, is it? You get a crossover here, we start to push right down, pushes back up. Now this is where it comes into play that you don't just hit it straight away as soon as it crosses overbought. That's the same with anything I believe, any overbought oversold trading thing, guys, is that you wait for it either to turn back over or some further trigger. Why I think you need that third step in the trade, because this one rockets up, but eventually CCI rolls over. You're in short at some point here. Is it here? Is it late? I'm not gonna pretend that anyone's in at the highs here. Is it here? Or even if you're kind of taking it as you break below that candle there, you're a little bit late, but still there's plenty of meat in this trade. You're talking 1,000 pips. That's on a daily chart. I think you can use it on a 15 as well, like I say, an hourly, 4 hourly. This is a nice little strategy, one to build on. Really one that can work well, because you've got the trend behind you and you've got that pullback, so you're timing it on the pullback, and then just a third trigger, which again is probably up to you how you do it, whether you use a candlestick pattern or wait for that CCI to roll over. Anyway, guys, thoughts in the comments section below on this one. Just a reminder what we've got here, the settings before I go. I know this is a bit of a longer video. 50 period I have on an exponential moving average, and a 25 period on an exponential moving average. US dollar JPY happens to be this chart, daily chart. CCI settings, reminder, are 20 period, and the lines are just drawn at plus 100 and minus 100. Anyway, guys, hope you enjoyed the video. Give it a smash that like button if you did, and don't forget to subscribe if you haven't already for more videos from myself and other traders on this channel. Good trading, take care, see you in the next one, bye bye.